Good morning, I am Malik. Welcome to the War Room. Today is Tuesday, March 10th. If you were looking at yesterday's close, you were looking at a historic structural repricing of the Pakistan Stock Exchange. The market did not just correct yesterday, it underwent a synchronized institutional liquidation. The KSE-100 index shed over 11,000 points in a single session, shattering the critical 150,000 psychological support level and closing at 146,500. A drop of this magnitude is not driven by retail sentiment. It is driven by global and local macroeconomics colliding at the exact same time. The institutional algorithms have stopped looking at corporate earnings, and they are now entirely focused on geopolitical risk. Today, we are going to strip the emotion out of this crash. We are going to conduct a cold, forensic autopsy of this 11,000-point liquidation so you understand exactly what the smart money is pricing in. Let us begin with the global macro environment. The escalation in the Middle East with Operation Epic Fury has fundamentally altered the global energy calculus. We are seeing Brent crude spike, and more importantly, regional freight insurance premiums have skyrocketed. For the Pakistani equities market, this triggers a textbook flight to quality by foreign portfolio investors. Asset managers in London and New York look at our heavy reliance on imported energy, factor in the paralyzed shipping lanes in the Gulf, and recognize an immediate threat to our foreign exchange reserves. Their response is completely mechanical. They issue blind sell orders. They are aggressively offloading emerging market assets, prioritizing liquidity over valuation. That foreign exit is what pressured our blue-chip heavyweights yesterday. Giants like Oil and Gas Development Company and Pakistan Petroleum were not sold because their fundamentals broke. They were sold because foreign funds needed an ATM to pull their cash out of the region. While the global funds are reacting to the Gulf, our local institutions are reacting to the western border. Operation Ghazab-ul-Haq has resulted in a complete suspension of the transit trade with Afghanistan. For the KSE-100, that border is the primary export artery for the cement and manufacturing sectors. Companies like Lucky Cement and Maple Leaf rely on those export volumes to offset rising domestic energy tariffs. With the trucks parked and the border locked down, local institutions are abruptly revising their forward earnings estimates for the entire sector down to zero. Compounding this industrial freeze is the International Monetary Fund deadlock in Islamabad. The IMF review mission is maintaining its demand for a 300 billion rupee tax collection shortfall to be bridged. The finance ministry is caught in a trap. Imposing a super tax on the corporate sector during a border conflict and an 11,000-point market crash is economic suicide. But failing to secure the IMF tranche risks sovereign default. The market hates uncertainty above all else, and yesterday the local smart money priced that uncertainty in by walking away from the order book. Now, let us examine the mechanics of the tape itself. How exactly does an index drop 11,000 points so rapidly? It comes down to algorithmic risk management and leveraged clearing. Last week, when the state-backed plunge protection team artificially pushed the index up to 161,000, heavily leveraged retail traders chased the momentum. When the market gapped down yesterday morning and broke the 150,000 floor, those leveraged positions went underwater. By the afternoon session, clearinghouses and brokerages initiated automated margin calls. The risk management algorithms took control of retail accounts and force-sold millions of shares into an order book that had zero institutional bids. When forced selling meets an empty order book, the price collapses. That is the exact anatomy of the freefall to 146,500. It was a mechanical washout of leveraged capital. Despite the macroeconomic strain, corporate governance continues. Today, Tuesday, March 10th, we have several critical board meetings. These will provide an unfiltered look into how management teams are navigating the liquidity crunch. 10:30 a.m., the Bank of Khyber, a regional bank based in Peshawar, holding a meeting for matters other than financials. Given the suspension of trade on the western border, we are monitoring this closely for any emergency restructuring of non-performing loans in the KPK region. 11 a.m., Bhanero Textile Mills, another meeting for non-financial matters. The textile sector is caught between collapsed exports and high energy tariffs. Structural pivots or asset management decisions here will signal the broader health of the textile board. 11:30 a.m., Ibrahim Fibers, a synthetic sector heavyweight announcing annual accounts. We will be dissecting their forward guidance specifically regarding their energy cost management. 4 p.m., World Call Telecom, closing the session with their annual accounts. As a highly leveraged entity in the tech space, their late afternoon volume will be a leading indicator for the telecom sector. Here is your battle plan for Tuesday. 1. Respect the repricing. The index is operating at 146,500. Technical support levels are currently irrelevant because the market is trading on macro headlines, not charts. Do not attempt to catch the absolute bottom of a macro liquidation event. 2. Avoid the relief rally. If we see a green open today, understand that it is likely a mechanical short covering rally. Institutions that are still overweight in equities will use any morning liquidity to continue scaling out of their positions. 3. Cash is a position. In a volatile, high-interest environment, sitting in cash is an active and highly profitable position. Let the margin calls finish washing out the leveraged capital. Let the finance ministry resolve the IMF deadlock. We will deploy capital only when the macro environment stabilizes. I am Malik. We trade the mechanics, we respect the macro, and we protect the capital. Survive the Tuesday. Disclaimer, StockSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented geopolitical volatility. Trade at your own risk.